You must have seen many analyses using funds point-to-point return for 1 year, 3 years, and 5 years on various broker websites or financial websites. You must have seen star rating analysis for various funds. You must have seen even basic rolling return analysis. But this is different. Hello everyone, this is Karan and I'll be discussing Parag Parikh Flexi Cap Fund using 12 years of NAV and disclosure data, and it will be a never seen before analysis full of insights backed by data. We will be covering various topics starting from AUM growth and its performance against the benchmark. We will also cover its distribution of capital in different assets, sectors, stocks, and we'll also cover how it has performed in bear market and bullish market through drawdowns and rolling alphas. We'll also cover the part where they're most famous for their cash calls. We'll compare the cash calls against the performance and see how prudent have they been about their cash calls. So let's get started with the topics. So coming to the overall NAV growth against the benchmark and the fund size, if you see the margin of outperformance against the benchmark was not very wide until 2020, but that changed after 2020 crash and the margin sustained till date. And if you see the maximum expansion of NAV happened in 2021 with the highest annual growth of 212%. So this is the another milestone that happened after 2020 crash. So 2020 crash is a significant event for the fund. Coming to the capital allocation of the fund, where we'll see how many assets they have used and what are the assets. So fund managed Indian equity exposure through their core equity portfolio, which is the direct equity exposure, and then their arbitrage portfolio, where they are earning the interest difference between futures and underlying. Their foreign equity portfolio used to range from 25 to 30%, but that got hit by the SEBI's foreign investment limit, after which it started declining, and now it is around 10% after 2022. Fund was also using currency derivatives from 2015 to 2024 to hedge their foreign equity portfolio, but that changed after SEBI's circular on matching the currency derivative value against fund's foreign equity portfolio, and fund has avoided doing that. If you see, the reduction in the foreign equity has gone to cash and core equity. Now fund has even started investing in REITs in 2025. Now coming to the sectoral allocation of the core equity portfolio, that's what actually provides Indian equity exposure. Let's talk about the top 5 sectors funds invest in. So if you see, financials, IT, healthcare and auto have been a consistent constituent of the core portfolio since 2015. FMCG was included post 2020 crash. Financial were consistently between 40 to 50% until 2020, when IT increased from its normal range of 10 to 15% to 20%, and FMCG was brought into allocation. Financials post 2021 allocation got back to its pre-2020 range, and that allocation came from IT, healthcare and auto. Their allocation got reduced. IT, healthcare and auto went to sub 10 range from their pre-2020 allocation, and their allocation went to financials and other sectors. The other sectors are the remaining sectors which are not part of top 5, which were consistently decreasing until 2020, are now increasing since 2021 to 2022, which correlates the biggest annual jump in funds AUM and consistent growth in the AUM, and also seems that fund manager is forced to look for other avenues to invest increased AUM instead of high conviction sectors for diversification. Concentration is getting difficult with the higher AUM. Continuing the discussion around the high AUM and portfolio structure, even with high AUM, fund has been able to manage top 10 stocks concentration, which has been between 70 to 80% till now. However, post 2021, fund consistently increased the number of stocks from max of 22 to 30 in 2025. This confirms what we saw in terms of increase in other sectors in sectoral analysis. Continuing the discussion around top 10 stocks, Bajaj Holdings, HDFC Bank, ICICI Bank, and Axis Bank are the most consistent members of the core portfolio. HDFC Bank was exited in April 2022 before HDFC Limited and HDFC Bank merger, and was again entered in July 2023. In healthcare, Zydus Wellness has been in the portfolio for very long. In IT, Persistent Systems, Emphasis have been in the portfolio. However, for fund's foreign portfolio is majorly tech, so it gets exposure to like sector from there as well. Also, their IT portfolio comprises mostly of mid-cap IT. In auto sector, Balkrishna Industries has been a consistent member from 2015 to 2025. Other stocks have been Hero MotoCorp, Maruti and Mahindra. Continuing the fund's performance, let's compare 1 year, 3 year, and 5 year rolling alpha funds excess return over the benchmark against the market environment, which has been bullish, bearish, and even correction phases. So if you see, fund underperforms the benchmark during green or bullish phases with negative 1 year rolling alpha. However, fund outperforms the benchmark during red or bearish phases with positive 1 year rolling alpha. The 3 year rolling alpha has only been negative between 2018 to 19 and briefly in 2024, whereas 5 year rolling alpha has never been negative. So there is higher probability of outperformance if investing for 3 years and 5 years. Now, finally, comparing their cash level and the net equity exposure against their performance. Net equity exposure is nothing but their total equity portfolio summed with the negative values of derivatives or short positions in the derivative. And now, if you look at the chart, funds net equity exposure goes down and cash goes up during green or bullish phases. So they try to reduce their exposure and take their exits or reduce their exposure during the bullish phases and make their war chest, and during the bearish phases their cash level goes down and net exposure goes up where the buying during the bearish phases. And if you see, since 2022 there is a deviation where it is actually the cash level is consistently going up. However, exposure is managed through arbitrage portfolio as foreign equity cannot be increased. It's a trade-off actually. Fund underperforms in bullish phases and outperforms in bearish phases. Now, summarizing the video, we'll discuss the pros and cons of the fund. In terms of pros, they have a high conviction in allocation in terms of sectors and stock. They have a low turnover or low churn, which change the portfolio very less. They manage their exposure to the Indian equity through derivatives, arbitrage portfolio, and cash. They outperform the benchmark during bearish phases. The cons of the fund are the high AUM is leading to a greater number of stocks, so they need to look for other avenues to diversify the portfolio. The foreign equity as a USP is going down because of SEBI's foreign limited is now hovering around 10%, which used to be 25 to 30%. It mostly underperforms the benchmark during the bullish phases. So if you see in the performance chart, the 3 year and 5 year alpha mostly outperforms the benchmark. So if you want to invest and if you are thinking of investing or continuing to invest, then 3 years and 5 years should be your investing period.